Folks, we are live. Welcome to Thursday Night Stock Charts Live. And we have Apple's earnings out. We'll talk about that. We're going to talk about the war that we are in. We are at war. And you would have to think that the media is an accomplice for the enemy. And you have to only pray one day that they are held accountable for their actions. We're going to talk about that. We're going to talk about the market that is about to become extremely volatile. We'll talk about the banks. We're going to talk about the new threat from SEC chair to shorts out there. God forbid you short. God forbid you have price discovery in this economy. They don't want that. No. They want totalitarianism. They want top-down approach to the market. And we're going to talk about the closing price action of the equity indexes, as well as some stocks. Bear with me 1 second. Let me turn off the sounds of the computer because it's driving me crazy. There we go. Shut up. All right, let's get to it. All right, so Apple reported earnings. They beat on the top line, beat on the bottom line. It was a good earnings report. Okay, nothing great, nothing spectacular, share buyback, increase on the dividend. And when I see that, when I see a share buyback and a boost in the dividend, something stinks. Now, unlike other companies, Apple does not report their forward-looking guidance until the conference call. It is not sent out in the press release. They only announce it on the conference call. So I checked back in and I took a look at the share price. I'm saying, wait a minute, you know what? Something's not right here. The anticipated market maker move on Apple was around $6.62 by end of business Friday. And we haven't really moved all that much at all, a couple of bucks. So I wanted to do a little bit more investigation, and I want to play for you a video in a moment because you would never know it. But Apple actually guided down on forward-looking guidance, and the shares are not cheap on a relative basis. They usually trade at around a 24, 25 trailing PE ratio. They closed out the day at around a 28 PE ratio, so at the higher end of the spectrum. So Apple, let's talk about their guidance.
Let's start with the guidance. They essentially guided for revenue to be down 2% in the June quarter. Let's start with the guidance. They essentially guided for revenue to be down 2% in the June quarter. The street was looking for plus 2%. As you mentioned, there's a 4% FX impact there. Sometimes investors factor that in, sometimes they don't. It's a guide down any way you cut it, and which begs the question of why is the stock hanging in there? Why does it continue to inch higher? And I think investors made up their mind going into this call that this is generally a good quarter, and specifically related to this installed base. And I've heard
All right, so they guided down. No matter what he says, they guided down for the next quarter. Now, that makes sense because of Qualcomm and their forward-looking guidance. They make the chips that go into these phones, and they guided down as well. So it all makes sense. Yet the question remains, why are Apple shares up? They're not cheap. They should be down. And they're at the upper band of resistance on a historical chart. So I think that while they're trading up right now, I don't think it's going to last. And the reason why I think that's the case is that when you take a look at the NASDAQ 100 futures. Now, keep in mind, Apple is the second largest component of the QQQ, which is a composite or an ETF for the futures NQ. And you could see that they're just holding in there. They're pretty much on the session, not really benefiting all that much from Apple being up and not looking all that exciting. So with Apple now being in the rearview mirror, I think everybody was waiting for Apple. We have jobs data coming out tomorrow. if it's anything like the jobs data we've seen already this week, which is not good. ADP came out, not good. You had jobless claims increase today as well. So the ice is melting below our proverbial feet. The question is, are we ready? And is this the time? Now, anytime I've done a lot of damage to my portfolio is when I shorted in anticipation of an event, meaning a breakdown. We may have been still in an uptrend, and I went short. And I fought it. I fought the trend. Not appreciating the fact that the blow off top can rip your face off if you think you're that smart and you short in advance of a peak. So right now, I do have a short position on. It's not anywhere near the size where I want it to be. I did short last week, buying some puts on the Qs. I stopped out really quick on that, but I am contemplating reshorting the market yet again. I want to see how the week closes out. Do the Qs rally off the lows of the week, or do they break down below last week's breakout point? Because if they do, I'll be shorting into that weakness. We're going to go over the chart of the Qs in a moment. We're also going to talk about the performance of the small caps relative to the large caps. Can you believe that on a relative basis, when you do a ratio chart, I'll show you in a moment, a ratio chart of large caps versus small caps, the small caps are at the lows of 2020 during the COVID sell-off. So a lot of weakness out there, a lot of debate. Maybe that's a signal to buy the small caps. Maybe it's a sign that they're going to go lower. You don't know. You know when they break. You know when they break. It all goes back to the market sends you signals. If they break down to new lower lows, that's the market telling you small caps going lower. So we'll take a look at that chart in a moment. But I'm very, very concerned about this inaction after hours on Apple. Every fund out there has Apple in it. And I think that they're not selling right now because they need volume to get out. And they won't get that type of liquidity until tomorrow morning at the open. So my guess is they'll spike Apple at the open tomorrow and then reverse it to close it down lower. So we've got to wait tomorrow. We're going to allow for some price discovery. We're not going to do any shorting until we see how the market is prepared to close out the week. Let's get to our other data. All right. So economic data this week. I didn't say a lot of people. Jody, your alert worked right on time. Very prompt. Larry, best Kentucky Derby long shot this year is 9 Skinner. He's 20. Is that this weekend already? God, time just flies. Hey, Paul. Trader Isaac, hello. STNE finally making some progress. Sadly, the most national news is, unfortunately. We don't have news. We have propaganda. Talon, welcome. TZ Burton, welcome. I trade small caps today. It was rough. I bet. Yeah, they're getting beat up pretty bad. Okay. So economic data that came out this week, we saw a miss on manufacturing. We saw a beat on the ISM manufacturing, but that's still a contraction reading. Any read below 50 on ISM is contraction. Job openings, that's JOLTS. They're contracting by 100,000 jobs. Factory orders missed. ADP employment. Actually beat. I'm sorry, they beat. ISM services still in a expansion mode. We know what Fed Chair Powell did yesterday. And productivity, look at that miss. Wow. U.S. productivity, a big miss. What else do we have? Tomorrow we're going to have non-farm payrolls coming out. And that could be the other reason why the markets are holding up right now in anticipation of that report. Now, the regional bank crisis here, folks, is truly a crisis, but it's clear that the Federal Reserve and the regime in Washington is having the news media run block for them because it's not getting the attention that it deserves. So you're seeing Western Alliance Bank, what's the other one? Whatever it is, Pacific West Bank. They're going to they're in buyout talks. Lord knows who the next one's going to be. If Schwab is under threat of going under, I think that's ultimately going to take this entire complex down. So keep an eye on Schwab. Unfortunately, I have an account with them. And let's take a look at a little bit of humor, a little bit of foul language. This is a family-friendly show. I'm going to play this, but if you have children around at the back end of this, you may want to mute your microphone. Let's hear what Jay Powell has to say.
Good morning. It's obvious I was lying during the press conference. Banks are, in fact, not fine. I just have to make them cheaper next time for my dear friend, Jamie Dimon, the real chairman of the Fed. Did you regards forget who appointed me? The Mango Man did, and I am a seed agent of chaos. Most of my tenure has been chaotic and historic. The first global pandemic, then my money printer's quantitative easing that you all got hooked on. Now, a recession in an election year would complete my character arc as a Bond villain. These regional banks were too addicted to sucking on my money printer. They sucked it so hard and long that they OD'd. What's God without a little OD? He's just a G. More than 100 banks died in 2008. We've only had like 3 so far. We still have a long way to go. I know there will be idiots who buy puts on banks in their Robinhood account and then complain that their 300,000 in gains are stuck and want to sue Vlad and Robinhood. Vlad works for Kenny and me, okay? Your lawsuits are not going to go anywhere. When I dropped my mixtape cipher, you bulls didn't listen. Now you better hope and pray that Tim Apple saves your market, but given what Qualcomm just said in their guidance, the chances of that are skinny. You all got used to VIX being down at 16, now you will see what happens when Vol jumps back up. You should have listened to Jam Croissant when he said that there was too much potential energy because of where the spooze was. Also, you fucks, especially you Sater, forgot why they say sell in May and walk away. Now don't fucking complain about Gamma being unstable or some shit. Go eat your cup noodles while you seethe and cope. I swear Bill Ackman is going to be on TV tomorrow crying about banks again. He's such a little whiny bitch. He wouldn't last a day in my world without someone pimp-smacking his stupid face. Lastly, I want to readdress that regarded journalist who asked if I had regrets. Yes, regrets I have a few, but then again, fuck your puts, fuck your calls. Jay Powell has you by the balls. God bless my money printer. Good morning.
There's one a lot dirtier than that one. I was going to play it, but this seemed more timely. I'll play the other one on Sunday Night Futures Live. So if there's any reason for you to subscribe to the channel, it is certainly to hear the other one that I'll play on Sunday Night Futures Live. I watch these like over and over again. I'm addicted. So it's pretty funny, but in reality, getting back to the seriousness of it, it's really serious. You know, Peter Schiff put out this tweet that when the rising interest rates pricked a Fed-inflated credit bubble in 2008, causing banks to fail, the media called it a financial crisis. Well, the same thing is happening again in 2023, only on a much larger scale. Yet the media refuses to call it what's happening a financial crisis. They got to protect the regime. It's all about protecting the regime. And frankly, you really can't blame Biden. I mean, this stuff's been going on since Bush the Jr. So I don't even necessarily blame Biden, but they know that if these banks blow up, they can't have him getting blamed for it. So you have an election coming up, and they're going to run, block, and tackle for him, and they're going to blow smoke up your you know what to make sure you feel fine and dandy in your bank and you don't move that money. Because at some point in time, they're going to come down and they're going to fence off deposit withdrawals. And that's when we go really, really third world in this country. If there's a continuation run on these banks, and the moment they say you can only take 100, 200, 300 bucks out of the bank, look out below. Look out below. So to quantify where we're at relative to the financial crisis, here's a look by bank failures by year. And here was 2007, 2008. We have already surpassed it by a mile. And perhaps it's the number of banks back then relative to what we have right now. It's a relatively few number of banks, but by total assets, vastly more than what we saw back in 2008. And nobody's talking about it. To be fair to Bloomberg, I will say this. They had an excellent interview on today with, I wish I remembered their names. I was in the car, and I got to tell you, these guys scared the you-know-what out of me. So, on Sunday night, we went over the charts of, we wanted to be middle of the field and say, okay, this is what the bulls are looking at in the chart. If this happens, then we're going up higher. If this happens on the bearish chart, then we're going lower. Folks, more and more each day that goes by, even though last week we had a very bullish breakout on the equity market, I mentioned back then, I thought that it was window dressing for the end of the month. It was a month-end markup. And as we begin to close out this week, it appears more and more likely that's exactly what we saw as we hit major resistance on the S&P 500. So, you have, just going back to this tweet here for a moment, the Fed is still tight. They're still tightening. The problem with the banks right now is that the Federal Reserve, I don't believe it's that they tightened too fast. It's that they had horrible risk management. They thought that yields are going to stay low forever, and they just were not prepared for rates to be at where they are right now. And the reason why this is all happening is that you have depositors that are getting paid 0.01% on their deposits because these banks bought treasuries for 30 years out, paying nothing, pretty much zero interest rate, and they can't afford to pay depositors what they can get in treasuries. So now they're needing to scramble. So what does the Federal Reserve, and this was on the Bloomberg report, what does the Federal Reserve need to do? They need to cause a crisis. They need to cause money to rotate into the bond market. What does that do? What that does is it drives down yields, and that helps salvage the banks. Unfortunately, we're going to pay for it again. It all comes back to us paying for it. So what did I do today? I began to dip our toe into the bond market. We bought calls, a call spread on the TLT, and I'll show you a chart of 2008 financial crisis, and I'll show you what did well and what did not do well, and when did they begin to outperform equities in a moment. TLT, gold versus the triple Q. So stick around. We'll talk about that in a moment. Going on with this tweet here, a recession hasn't even started. I disagree with that. I believe it started in Q1, Q2 of 2022. Equity, when we have back-to-back GDP of negative growth. Equity valuations remain extraordinarily high. So let's validate that. We talk about this every single live stream. Is he accurate? Yeah, here's the Shiller PE ratio. We're at 28.61. This is real time. The mean is 17. This market is very, very expensive. Yet you have the pimp Mac daddy of them all, Apple, which is now reporting guidance for next quarter on revenue to be lower. They expected an increase in revenues. They're predicting a decrease in revenues. And yet they're trading up after hours, and they're trading at a historically high PE going into earnings. What's that all about? I was talking to, I mentioned this to members earlier today. I was talking to Jake from, he was with TrendSpider, no longer with TrendSpider. We went out to lunch in Manhattan last week, and we were talking about where we're at right now relative to the financial crisis. And I said, Jake, yeah, I'm older than him. And I said, Jake, have you ever read Reminiscences of a Stock Operator? And he says, yeah, I have read about it. And he's very intelligent. And he says, I said, this reminds me of that book, the story in Reminiscences of a Stock Operator, when the stories about Jesse Livermore in reality, one of the most famous traders there was ever. And he was expecting to go in short to work one day because he had the San Francisco earthquake the prior day. And so he came in and the bull market was on a tear. They were ignoring it. And I said, what this reminds me of is the markets during just prior to the great financial crisis. And I remember watching, everybody knew there was a definite date of 2008 that you're going to get the resets on mortgages. These are contracts. Everybody knew this was going to happen, and everybody knew the underwriting for those loans was dog poop. Yet the markets didn't care. They just continued higher. A year before the bubble burst, the home builders, which were on a ripping tear up higher, their earnings were rolling over. And I knew when KB Homes sold their financing unit that there was something very, very wrong. And I got short the market just in time. And we enjoyed that ride down. But the market ignored. Nobody says you see bubbles coming. Everybody should have seen that bubble coming. I saw it. And you go back to 2020 when COVID hit. I was live. I was on a live stream for TrendSpider, their symposium. And I said, nobody's paying attention to China. Pay attention to China. There's a supply chain disruption, and the equity markets just continued higher until it stopped. I think that we're at this same stage again. And the only question that's out there is what's going to be the straw that breaks the camel's back. You had a date certain during the financial crisis. You had COVID, which was just ripping up higher. That was a freight train coming down the pipe. And now you have banks going under after the federal. Jamie Dimon come out yesterday afternoon. What did he say? He said that the banking system is stable. Jay Powell later on in the afternoon, the banking system is stable. I'm paraphrasing. What happened 1 hour later? Western Pacific Bank or Pacific Western Bank, they decide that they're looking for a strategic option. You know what that means. They're going under. So there's something very, very wrong here. And we got to see through the lies that are being told, the smokescreen. Remember, banking is a con game. It's a fractional reserve system where they can, for every dollar they take in, they can loan out 10. They don't have the deposits on hand to be able to pay you back. They cannot have all your deposits leaving these banks and going into treasuries, Bitcoin. They can't have that. They won't have that. So they need to cause a crisis to drive down yields. And I think that they're going to let a crisis take hold in the banking system. And that's why I bought the TLT. And we're going to talk about how the TLT did during the 2008 financial crisis relative to gold too. So this is put out earlier today, I think after the market closed. This is your wildly incompetent SEC chair. Chair Gary Gensler, his honorable, the esteemed Gary Gensler, May 4th through 2023. As I've said, in times of increased volatility and uncertainty, the SEC is particularly focused on identifying and prosecuting any form of misconduct that might threaten investors, capital formation, or the markets more broadly. What are you telling people? Not to short stocks here? What are you saying? You're not allowed to go onto a forum and talk about how weak the banks are? Am I going to get a fine for talking about how weak the banks are? I wouldn't be the least bit surprised if this video is stricken from YouTube tonight. This is what this guy is talking about. These are threats. These are threats against me, against you for shorting these banks. So that's our government. And over in the EU, we have more. We're at war. We are at war. If you don't believe that we are at war, you have the Netherlands now shutting down 3,000 farms. They are trying to cause a food crisis. That way you need to rely upon the government. You're seeing it here. Bill Gates buying up all the farmland. This is all a planned operation. The psyops that are going on right now. What's a woman? What is it? All this nonsense is really just one big psyop. And unfortunately, our government is the key culprit in it all. And you take a look, speaking of our government, apparently the president of the United States, Joe Biden, engaged in a bribery scheme with a foreign national. FBI internal document alleges. They got this document from an internal source that he was taking bribes 3 months after they had Hunter Biden's laptop. This is before the election, and they withheld it. That is election interference. You have the CIA and the FBI interfering in elections. It's not just once, it's multiple times now. And this is just another example of the war that we are in. And unfortunately, they have the power. We have the numbers. They want you to think they have the numbers by all these loud screaming, whatever they are, these woke morons, but they don't. You have a couple of thousand maybe, but they're loud. They're loud. And it only takes a few thousand, it only takes a small percentage of the population to change the culture. And unfortunately, that's what we're seeing right now. All right, the Federal Reserve's balance sheet, another reason why this market could be in for a tumble. And while I applaud the fact that they're rolling off debt off their balance sheet, I don't applaud the fact that you have banks going under due to the fact that the Federal Reserve raised rates quickly and to these levels, and they're not adopting a wait-and-see approach. They, again, reduce the size of their balance sheet in the face of banks going belly up. So a lot of opinion is that this is a lot of ego on the part of the Federal Reserve, but due to the fact that they said that inflation was going to be transitory. They were wrong, and now they're trying to get back their credibility. But unfortunately, the banking system is not able to absorb these types of rate hikes because, yes, you have regulators out there who are blaming the banks, and the banks are blaming the regulators. But why didn't the regulators capture the fact that you have banks that were out there? So I think it was Signature Bank or one of the other one that didn't have a risk manager for 6 months. How does that happen? How do you not have a risk manager for 6 months and you have fractional lending out of your bank? How does that happen? That's a Ponzi scheme waiting to blow up, and it did. So nobody's doing their job. Nobody is on the job. All these people that come onto CNBC from the government, from the Federal Reserve, which is quasi-government, they have no idea what they're not talking to each other. Nobody is talking to each other and coordinating. All they're thinking about is, how do I save my ass? Because this is not going to end well. Yield curve. I talk about this constantly, because there's no other chart you need to watch. When the market is down, take a look at the yield curve. I'll bet you the yield curve is up. What's the yield curve doing this week? It's up 15% on the week. The yield curve is steepening. Now, it hasn't put in a new monthly high yet. That's what I'm watching. And if we do put in a new monthly high in the equity market, on the yield curve, I think the equities are going to roll over. So we're watching for that. And let's take a look at where we're at. We're pretty far ways away from the highs of the month last month. But don't forget, is this accurate? Wow, do we take out the last? Well, I want to make sure I'm looking at the right chart here. Wow, we took it out today. We took out the highs of the month. Wow. This doesn't update until after the market closed. And sometimes it takes an hour or two. Let me go back to that weekly chart for a moment and see how that looks. Wow. We have a continuation breakout on the steepening of the yield curve. Wow. So, you know, for you folks out there that aren't familiar with the yield curve is, basically when it inverts, which we're still technically inverted, uh, equities can rally, which we've seen, right? But when we steepen, it's when equities begin to buckle. And the markets are anticipating that the Federal Reserve is going to have to step in here at some point in time. Yet the Federal Reserve is saying they have no plans to cut rates. So I'm kind of taken aback right now by how fast we recaptured last month's losses, and now we're above last month's highs. That's a continuation breakout on the yield curve. Let's see what futures are doing here. Apple still within the market maker move, still up in the after hours session. There's your uptrend channel. Let's create an alert here. I want to know if we break. I don't think we're going to break tonight. The NASDAQ 100 is capitalizing here a little bit, but no real excitement. Could see that giving back. This is only a 1 minute chart. Let's get off of this. Yeah, nothing really happening here per se. You know, what you would expect to see if Apple's numbers were so great, you would expect to see broad-based buying of the tech sector right now, and that would be reflected in the NASDAQ 100, which is the reason why I keep going back to it. The problem is you're not getting any type of carry through from Apple's up momentum to the NASDAQ 100. I don't think that this holds. I think that they'll open the market up higher tomorrow and they close it lower. And we're going to be watching them to throw on some shorts tomorrow afternoon, adding to our position. It all depends on how we close out the week. And I don't want to add until I know that we have broken support on the triple Qs. Interesting. Okay, let's take a look at some closing price action of some charts here. We're going to talk a little bit about gold. I want to spend some time on bonds first. Now, as I mentioned earlier, we put on a bond trade, long of the bond market. And this is a pretty good illustration of as to why. And it's really not a technical reason per se that I added to it. I'll go to the reason why in a moment. We're still in a trading range, but we're at that lower band of the trading range on a weekly time frame. But when you take a look at going back in time, let's go over to the Qs. And where are the Qs? Here, let's bring them up. So what we want to do is we want to think really high level and do some analysis of what does well when the equity markets go into free fall. And I've done this many, many times preparing for what's about to happen. And again, I'm not saying it's going to happen tomorrow. I'm not going to say I don't know when it's going to happen. I'm just confident it's going to happen. And we're going to go back. January 1, 2008. And this gives you a pretty good picture of the disaster that was the financial crisis. Now, what I want to do is I want to overlay here two products. The first, PLT. That's the 20-year bond ETF. We'll make it behind the price. We will make it let's make it a nice orange color. And then we're going to take GDM. This is the gold mining index. And we'll make that gold. Let's clean this up. And here you have it. All right, so this is a daily chart. Let's go to a weekly chart, make it nice and clean. Okay. So you can see here that the QQQ topped out in June of 2008 at $44.39, double top in August of that year, $42.63, broke support at $38 a share. That was a double top, confirmation breakdown. That's the breakdown below a pivot point. It was game on to the short side from there. So TLT overlaid here in orange. What did it do? It moved up. Why did it move up? It moved up because you had a flight to so-called quality treasuries. So the TLT did very, very well, whereas gold, or the gold mining stocks, took it on the chin. Now, why did they take it on the chin? There was fear. Why wasn't there a flight to quality into gold and the gold mining stocks? Well, gold didn't get hit that hard. It went down, but not as hard as the gold mining stock. Why did the gold mining stocks get hit? Think about this chart here. This is the triple Qs. Overlay the S&P 500, overlay the Wilshire 5000. They got all hammered, and everybody was on margin back here because everybody was apathetic. They thought there was no stopping the bull market. We had QE, blah, 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 blah. And actually, there was no QE back then. I apologize. You had a market that was not believing that there was going to be any end to the housing boom. And in reality, it was done already. They just didn't know it yet. And margin calls went out because people didn't believe that stocks could go any lower. And as I always like to say, when you have a market that's in a bear market and free fall, today's lows could be tomorrow's highs. Just when you think that the market can't go down lower, it goes lower. It is dehumanizing. It's demoralizing, I should say, demoralizing if you're long and you're fighting it, because you just see your account evaporate. Ultimately, relative to equities, the mining stocks recovered first. And then you had the equity market consolidate, and then they moved up higher. But what I'm looking for here is when the market breaks is a sell-off. I lightened up on the gold mining stocks and the silver stocks. Silver miners, I should say. Silver I lightened up on earlier this week. And I want to have liquidity on hand, meaning I want to take the money that is currently in tips and in treasuries and in cash reserves. And then on any pullback, a major pullback on the gold mining stocks, I want to be a buyer. But right now I see too much deflation coming into this economy. And that's my concern. How do we get deflation? Simple. Right now we are in a run on the bank crisis. But now the banks, they don't want to lend out because they don't want to let the money out of their coffers just in case they get a run. So they're tightening up on their lending standards. And if they're not lending out money, that means companies can't create or grow. That means they won't be able to produce as much. Therefore, people won't be able to buy as much. That's why you get a deflationary cycle. It could be brief, could be several months to a couple of years for all I know. But on that pullback, on any type of a bloodbath in the mining stocks, I want to be a buyer. But I have lightened up on them. If gold breaks out, then I'm wrong. If stocks break out, then I'm wrong. Then I got to buy. I got to pay up. I got to buy them back. So that's the game plan right here, right now. These are the correlations that we're watching very, very closely. In short, I'm predicting a risk-off environment despite Apple's earnings. I don't believe what's happening after hours is the way we're going to end up the end of the month. What else we want to take a look at? KRE. These are the regional bank ETFs. And I don't think that we're anywhere near the bottom. I think that we have to take out the lows of 2020, which is $25.70, before we can say, okay, you know what? Maybe it's time to start looking at these things as a bargain basement, looking for a bounce to the upside. I don't think that we're there yet. So not enough blood in the streets, but I think that we are going to get it. And when you take a look at, when we're speaking about 2020, when you take a look at the small caps relative to large caps, take a look at them on a monthly view. Now, this is the performance of small caps versus large caps. Take a look at where we're at. We are flirting with the lows of 2020. And I think that we're going to break and go lower here. So if you're thinking about buying the small caps right here, right now, you may want to think twice about that. While they may bounce relative to the S&P 500, this is a weekly chart now. It looks as though in all probability they're going to continue to underperform the S&P 500. And IWM weekly chart standing alone, this is not a good looking chart. You have the 50-period moving average, which is going to probably cross down below the 200-period moving average. You have the 20-period moving average in green, which is threatening to take out all three. This is not good. This is bad. So the moving averages here are going in the absolute and utter wrong direction. And this is a weekly chart, not a daily chart, which is going to take several months to heal this. This could take upwards of a year or two to heal. So not looking good. Path of least resistance for the small caps is clearly to the downside. I would not be a buyer here. A lot of people on Twitter talking about how ARK is looking good. Maybe it's going to rip up higher for all I know. It could quite possibly. Maybe the large cap stocks take a pause here. And at the end of a rally, what happens many times is that you get a pausing of the large caps, a rally in the what you call most heavily shorted stocks, which are the ARK stocks. They move up higher, they poop out, and then everything rolls over. So right now, I would avoid the small caps. Talking about. That's my Long Island accent that just broke through. I captured it though. I'm self-aware. Gold quarterly chart. It looks beautiful. It looks absolutely beautiful. I haven't sold one bit of gold, not 1 ounce, and I think that it's going to go up higher. Is that talking out both sides of my mouth when I say that I'm still bullish gold, I'm cautious on the gold mining stocks? I don't think so, because if your central banks don't get margin calls, right, they're going to hold on to that gold they have in storage. If you're holding physical gold, you're not going to get a margin call on that gold. If you're holding paper gold, you may get a margin call. But while I think that if equities roll over, gold will probably pause and pull back some, as it did in 2020, 2018, and 2008, it will not go down as much as the gold stocks. That's my major concern, is the gold stocks going down with the rest of the equity market. Why? Because people are going to sell what they could sell to meet margin calls. Simple as that. It's not that I'm bearish on the gold mining stocks. I'm very bullish, but I think we're going to get a pullback and a buying opportunity. Also, what we're going to be looking for, what time do we have here? When we do get this sell-off, is emerging markets ex-China. And finally, I was listening to Jeff Gundlach yesterday, and he's one of the few voices out there that I respect, along with Peter Schiff. And what was he talking about? Buying emerging markets ex-China. You got to avoid China. Most of these ETFs have 30% China in them. If we go to war, if we put sanctions on China, if they attack Taiwan, even if we don't go to war, guaranteed they're going to delist those stocks, just as they did the Russian stocks here. What happens to all of these emerging market ETFs that have China in it? Overnight, a 30% haircut. Done. Wiped out. So be careful of these emerging market funds with China. Be careful. They're overweighted China. That's why we're using not EEM. We are using EMXC, ex-China. EEM is 30% China. And you can see it's moving up nicely. Down in the month, but holding support. What else do we want to talk about? I think we're good. Let's talk about, look, but you know what? I want to take a look at Apple for a moment. Where are we at technically on Apple? It's extended. You know, you don't want to buy it here. I think they're going to sell it off. Here's the PE. I mentioned this earlier. PE of 28. Historically, it's got a PE of 24 to 25. They just reduced forward-looking guidance. That means that on a forward-looking basis, the stock is more expensive today than or after the announcement than it was before the announcement. On a forward-looking basis, not on a trailing. Now, there's a little bit more room to run up here to about 175. But you can see right now on this chart here that were we to close out the week where we closed today or worse, it would be a failed breakout. Remember that last week we had a bullish breakout on Apple. This week, at current right now, we're trading down below that support level. This market needs a major run tomorrow. And I'm not saying it can't happen, but a forward-looking guidance reduction on Apple, I don't know. You want to go buying Apple stock tomorrow? So buckle up, folks. Let's see what Apple's doing in the after-hours session. Can't close above 170. Volatility is under control. Is my head in the way? No, you can see it. Let's take a look at what the dollar's doing here. Oh, gotta put the dollar sign. Dollar moving up after hours. And gold is up flat fractionally. Okay. Let's see what TLT is doing. TLT was down. We bought on weakness today, but it's up in the after hours session slightly. All right. Let's do some chart requests. Actually, let's go to comments. I wonder who had the largest exposure to. You know, that's a good question. Normally, you would expect to see BlackRock and Vanguard. How much you want to bet they didn't have an exposure or a big exposure to Pac West? That's a good question. It's a very good question. When China government bought up all their farms, they all starved. That never works. Correct. But what was the goal of buying up the farms is to be dependent upon the government and control the food, control the people. And that Kissinger said that a number of years ago. And control the money, you control the world. And that's why we're ready to go to war with China, because it's threatening the reserve status of the US dollar. What about buying TLT, not options? Yeah, that's fine. That's fine. Seems like it is a channel between 100 and 109, but VCP forming. Yeah, it's fine if you want to do that. I bought the options because they're cheap. They will never investigate China, Joe, because they'll prove Trump won and was right all along about Biden crime family. J6 wouldn't have happened. Correct. Franklin, welcome, my friend. Jody kicks it off. AMD, Microsoft. All right. Let me get my notepad out here. AMD. Nice reversal day on AMD today. HSY. That's Hershey and TAP. Those are good ones. Hey, Gabe. Welcome. I went over KRE a few minutes ago. Maybe you posted this before I went over it. I think it goes lower. I don't think there's a trade to be had there. I think you need blood in the streets. It's there now, but I think you need more. You need more heads. I think you need a big name, and I'm worried about Schwab. Watch out for Schwab. Dan the man. Does BlackRock invest in every company? Pretty much. Vanguard, BlackRock. Yeah, that's the way they get control. Yeah, let me do this. Let's do this. All right, so we did our due diligence. We did not make assumptions. Here are the largest holders of big shocker. Vanguard, they have 11.35% stake, yet they reduced it. Actually, Vanguard, yeah. BlackRock, they increased their position. All the big names. Who else had positions here? Fisher Assets, they call me all the time. No great shocks here. I'm just surprised that Vanguard and BlackRock weren't able to get out before. Maybe they did. I don't know what this is as of. All right, so that answers that question. They may have taken a haircut. All right, let's do some chart requests. Folks, you're going to be using TrendSpider Automated Technical Analysis, 35% discount code below. And they are giving away on their top tier package a 50% discount on their top premium package. So link below on that package if you want to get like top tier version. And let's get to it. AMD. AMD did not rally on earnings. They sold off. Weekly view. And they reversed today. But we're still down on the week. We're on a downtrend channel on AMD with volume rising to the downside. Daily view. I wouldn't be a buyer here until we broke out and above, let's call it $88 a share. Because, yeah, we recaptured a couple of support levels today. Very great. It's great that it happened. But the question is, does it hold it? And does it have the muscle power to break above resistance? So I know that AMD, I think the reason why they rallied today is because AMD teamed up with Microsoft to build a chip to compete with NVIDIA for AI. As a matter of fact, there's an article on that. Let me see if I can dig that up for those that are interested. Here it is. And there you go. So I think that's the reason why AMD reversed today. Let's see if it's got legs. You know, they could be in preliminary stages, and those chips don't hit the market for a year, 2 years. So who knows? You know, maybe they're ready to go right now. I don't know. I'm not that smart. Therefore, I wait for the price action. The market's going to tell me whether or not it's time to buy this, and close above resistance at around, what did I say before? Say 88.50. That would have me in the shares. Microsoft, Mr. Softy. Now, I know some people are shorting Microsoft right now. I get the why behind it. I don't like the weekly chart. It's an inside week, no follow through on last week's major move up higher. Maybe it's consolidation. If you take a look at the daily chart, it will kind of validate that it could be consolidation, and they're getting ready for a breakout here. So me personally, I wouldn't short it. I wouldn't buy it yet. I'm concerned about the market right now. Therefore, in a healthy bull market, I would buy this right now. But we're not in a healthy bull market. We're in a market that is on quicksand. So we're seeing far too many false breakouts, far too many false breakdowns. When you see that kind of volatility, either at the top of a market or a bottom of a market, that means you're going to go the opposite direction at some point in time pretty soon. So I would rather wait for the breakout here before buying Microsoft. So look for a breakout above 207, 208 per share. And there you go. Alert is set. Hershey. Good looking chart. Path of least resistance is clearly the upside. We broke it up above resistance, pulled back. Not quite a retest, but close enough for government work on the week. Volume is good. Daily chart. I think this is going higher. Hershey's looking very good. Ugh, I screwed that up. Again, I screwed it up. All right, you get my drift. It wants to go. It wants to go higher. Tap. A beneficiary of the nightmare over at Anheuser-Busch. It's extended relative to its third standard deviation Bollinger Band. A little bit extended here. I think you need to pull back on tap. But the daily chart looks good. It looks like it wants to go higher. It's a consolidation. Good looking chart. I'm concerned a little bit about the weekly chart. If you're going to buy here, I'm fine with it. Just stay small, wait for that weekly pullback, add more on that consolidation and a weekly breakout to new higher highs. I think it looks good. Rock solid names here on the consumer staple front. QJ, I play between. Yes, correct. Yeah. I know you're waiting on gold stock. What do you thought about Nugget Bob? I mentioned it earlier. We always want to be. We always want to provide disclosure. I did lighten up a bit on Nugget, in particular, not the GDXJ, but Nugget in particular, because the leveraged ETFs, when they go, they go. So I wanted to lighten up there. AGQ is also a leveraged ETF. We lightened up there. The shares have proceeded up higher since we sold. Do I regret it? Yeah, of course you regret it. You're always saying, should I have done that? But it always goes back to liquidity. You know what's out there. There are a lot of signals in the market right now that all is not right with the world. Yet nobody's talking about it. The markets are not responding, and the markets are expensive. I don't know what they're waiting for. I don't know what they're waiting for. There's no good news out there. So I would prefer to have the capital the liquidity on the sidelines so that I am able to react and take advantage of any quick pullbacks in the marketplace and take advantage of what I perceive to be a sell-off in the markets, subsequent margin calls on accounts, whether they be hedge funds, they're leveraged up as well, individuals or retail money. They're going to sell what they could sell. And that's the gold mining stocks are not going to get spared. So that's my take on it. Maybe I'll be proven to be wrong. Maybe history, maybe it's different this time, but I don't think it will be. That's my take, but I'm still long of those names. I still like those names longer term. BA, we'll go over BA. Tap may introduce a hard look. Oh, really? Well, beer sales are down overall. Yes, I believe that. You're welcome, Jody. You're welcome, Gay. Anytime, pal. Sean, you're very welcome. And let's wrap it up with Boeing. Boeing, I did a video on. I don't know if anybody watched. It's on YouTube. I made it last weekend, so it's still pretty relevant. And we remain in the trading range I discussed on a video, but we're nearing a buy point. I always like the 190 mark on Boeing. The algorithm here on Boeing shows support monthly time frame at around 181. If we get a sell-off in the market, we could certainly hit that. But if that sell-off does not occur anytime soon, then I think that we could hold support where we're at right now. The month is not looking good thus far. We're down nearly 4.5% on the month. We're only 4 days in. And on the week, we have broken support. Technically, we did it 3 weeks ago. We did a retest last week. Now we have a continuation move lower. So I think that these are shares that are under pressure. They're probably going to proceed lower. Daily chart very weak. I'm not a buyer here until we hit historical support levels and we see down volume begin to move down below average. So I would avoid right now. I think you're going to get better prices here. I would wait for the 190 mark at bare minimum. If the markets begin to sell off, then I would send you back to the monthly chart and start watching that 181, 182 mark on Boeing monthly chart. And that is it, folks. Thanks for being here. Have an awesome Friday and an amazing weekend as well. Please like, subscribe. Don't forget TrendSpider, discount code below, 35% off. And thanks for being here. Be well. Have a great night.